Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, the owner of Capital Wealth Group, a fee-only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement.
So let's get started. Today we're talking about how to create a truly successful retirement plan and why the order in which you tackle each piece really matters. We'll cover the three big items: your income plan, your investment plan, and your tax plan. By the time we're done, you'll see why starting in the wrong place can leave you feeling boxed in, and how this simple shift sets you free to design the retirement of your dreams. So step one, start with your vision, not your numbers. You might assume step one is running to your brokerage statements. Add up your balances and assess your risk tolerance. That's what most advisors will do with new clients. But starting with investments can actually pigeonhole your retirement. So instead, I recommend beginning by picturing your ideal retirement life without worrying about dollars just yet. Here's how to do it. Paint the picture. Ask yourself, what does a perfect day look like in retirement? Are you gardening at dawn, playing pickleball with friends, taking peaceful walks on the beach, traveling? Maybe you're volunteering your time. Maybe it's all of the above. Dream big, whatever lights you up. And then next, notice the emotions. What excites you? Is it peace of mind? Is it adventure? Quality time with family? Jot down the feelings and experiences that matter most to you. And then forget constraints, at least just for now. Don't worry about the money yet. This stage is about imagining the life you want, so you can build your plan around it, not the other way around. So why does this matter? If you start with numbers, you risk trying to fit your life into a budget. But when you start with vision, you build a budget that fits your life. Step two, translate your vision into an income blueprint. Once your vision is crystal clear, it's time to ask, what income will support that lifestyle? So first, list your retirement must-haves. These are your essentials, like housing, food, transportation, insurance, and so on. This is your base level of spending. And then second, list your nice-to-haves, such as travel, hobbies, gifts for grandkids, club memberships, whatever adds enjoyment, and then estimate the cost. And then third, map out income sources. Think Social Security, maybe a pension, annuities, possibly rental income, part-time work or consulting for a few years after full-time retirement. List all your income sources. And then fourth, this is where you bridge the gap. For most people, guaranteed sources won't fully cover your vision. Now you know how much income you'll need to draw from investments in year one of retirement. And then number five, you can run the 4% rule as a good starting point. For example, if you'll have $2 million at retirement, calculate 2 million times 4%, which equals 80,000. Ask yourself, will 80,000 fill your income gap? If yes, great, you're on track. If not, that's okay. If you've done this planning before your retirement year, you have time to make adjustments. Please keep in mind not everyone has 2 million, so this is just an example. This income-first approach gives you two big benefits. Number one, clarity on your investment needs. You'll know how much you need to save and what kind of returns are required to support your income goals, and that's powerful. And then number two, confidence in your plans. Instead of guessing, you've nailed down what your lifestyle will actually cost. So your plan is based on reality, not assumptions. And if the numbers aren't adding up yet, don't worry. You still have time. And there are other smart moves you can make. You could work a little longer. You could take on part-time work early in retirement. You could increase your savings rates now while working. or you could trim lower priority expenses in retirement. The key is awareness, knowing where you stand now so you can take action. So let's move on to step 3, build your investment plan to fit the income blueprint. Now that you know how much you need and when, you can design an investment plan that aligns with your cash flow needs. This is far more personalized than reliant on a generic risk questionnaire. Here's the approach I often recommend, and it's called the 2-bucket strategy. Forget the overly complicated bucket plans that you may have heard of. This one is clear, simple, and effective. For the full breakdown, listen to episode 23, but here's the gist. So bucket number 1 is your cash lifeline. This holds 1 to 2 years of expected withdrawals after factoring in your guaranteed income. It should be in safe, liquid investments like money market funds or treasury bills. You can make withdrawals monthly and replenish it quarterly or annually. And if you're very conservative, you can hold 3 or 5 years of cash if you'd like. It's a personal preference. And then bucket number 2, this is your investment portfolio. This is your long-term growth engine made up of stocks and bonds. Most retirees fall somewhere between a 30-70 and a 70-30 stock-to-bond allocation. The right mix depends on your unique situation, your comfort level, your risk tolerance, your needs and goals. Then you would rebalance your portfolio either quarterly, biannually, or even annually. If stocks are up, sell some to refill bucket 1. If they're down, sell bonds instead. Yes, 2022 was a tough year, with both stocks and bonds being down, but not all bonds. So if you had a well-diversified portfolio of stocks and bonds, this strategy would have kept you from selling at a loss. If you want more detail or examples, go check out episode 23. Now on to step 4. Optimize taxes to keep more of what you earn. Once your income and investment plans are in place, turn your focus to long-term tax planning. This is where many retirees miss out, and the savings can be huge. So the first strategy you may want to consider is called tax location strategy. This is where you place tax-inefficient assets like taxable bonds, high-turnover mutual funds, and even dividend-paying stocks in tax-deferred accounts. And then you would want to keep tax-efficient investments like passive index ETFs, passive index mutual funds, growth-oriented individual stocks, or even municipal bonds for those in higher tax brackets, in brokerage taxable accounts. And then think of your Roth IRA as the last bucket you'll usually touch. It's your most tax-advantaged account. It's ideal for growth, since you probably won't touch it for decades down the road. So here, again, you would add growth-oriented investments. And then when you finally withdraw the money, your Roth IRA, all the gains comes out tax-free. Okay, number 2, you may want to consider tax loss harvesting. If you've realized gains in the year, you can sell losing investments to offset those gains and lower your taxable income. To stay invested, buy a similar but not identical ETF or fund or even stock right away. And then excess losses can offset future gains or reduce your taxable income by up to $3,000 per year. And then number 3 would be withdrawal sequencing. And this one's huge, and it applies to most people in retirement. What is the best withdrawal order? The best withdrawal order depends on your unique situation. So you use retirement planning software to run scenarios. The most tax-efficient approach is often draw from taxable accounts first, then move to tax-deferred accounts like traditional IRAs and 401ks, and then finally tap tax-free accounts like Roth IRAs. This is not always the best strategy for everyone, so please use some type of retirement planning software or work with a financial planner. So why does this matter? The tax difference can be substantial, sometimes hundreds of thousands of dollars saved over retirement. That's more money in your pocket or more money to pass on to your heirs. And then 4, Roth conversions. This strategy lets you move money from a traditional IRA to a Roth IRA paying taxes now to avoid bigger tax bills later. Roth conversions can be smart if you expect to be in a higher bracket later, or you want to reduce future RMDs. I've covered this in detail in past episodes, so check those out. Just remember, it's not a one-size-fits-all situation. Talk with a financial planner and look at your whole picture before deciding. Now let's put it all together. The 3 pillars of retirement. So at the highest level, your retirement plan hangs on 3 pillars. Number 1, your income plan. You go from vision to cash flow. And then number 2, investment plan. Now you know your cash flow needs, and then you determine your asset allocation. And then number 3, tax planning, which we just went over. Roth conversions, asset location, tax loss harvesting, and the most important, withdrawal sequencing. By approaching them in that order, vision, income, investments, and then taxes, you gain clarity, flexibility, and peace of mind. So this isn't a cookie-cutter 60-40 approach. It's a tailored strategy built around your life. So wrapping it up, remember, it's not about charts and jargon. It's about starting with your dream, translating it into numbers, and protecting those numbers with smart investment and tax planning. It's a small shift in thinking, but it can make a big impact. If the approach resonates, I'd love to hear from you. Drop a comment, share your retirement vision, or let me know which steps you're tackling next. Until then, happy planning and have a great day.
Thank you for tuning in to this episode of The Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. If you'd like a free retirement review, visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.